Okay, hello everyone. This is another international tax planning technique that we are going to explain today in the next 20 minutes. This technique is known as transfer pricing. It is probably the most common transfer pricing. It is probably the most common international tax planning technique. And also as a result of it being used so commonly, the Revenue Department of Thailand and also the tax departments over the world are very cautious about this technique, and they have different methods to check, to investigate as to whether the underlying transaction is in fact a real transaction or not, rather than a fabricated transaction for the purposes of avoiding corporate income tax. Okay, let me just start by first explaining the aim of this technique. The aim of this technique is, of course, to reduce corporate income tax at the end of the accounting period of a juristic person, alright, commonly a year as the accounting period, alright, and the reduction of this corporate income tax is done through reducing the profit amount in each transaction. In other words, it is done through the reducing of corporate income tax at the end of the accounting period or the year is done through reducing the profit amount in the purchase price or the services sold in each transaction. So, for example, if you sell a pen like that, and the pen is say 50 baht. Alright, you make say for example a 20 baht profit. So the 20 baht profit would be the profit that could be exposed to corporate income tax at the end of the accounting period. So you would have to aim in each transaction to try and reduce that 20 baht profit in the sale of the pen or the services rendered. Alright. By reducing the profit for that particular transaction, you would thereby possibly reducing your net profit at the end of the year, and thereby reducing the exposure to corporate income tax. Okay, let me explain how the technique or the structure or the method works here. Alright, as you can see here, let's start from here. Ideally, you would want to have this sales contract here, whereby you have the situation of a seller in Thailand. Alright, we call it Thaiko, right, selling garment, let's say garment per piece. Selling garment per piece, right, at 20 baht to a purchaser, a customer in Kenya, or we call this purchaser or this customer a company in Kenya called Kenco. The purchaser, a company in Kenya called Kenco. Alright, and you as the seller in Thailand would be selling this garment per piece at 20 baht to this purchaser in Kenya, Kenco. Alright, and this purchaser in Kenya would of course pay you the purchase price, which you will receive as your income, 20 baht per piece. Now, if this 20 baht per piece goes into your income, this 20 baht here comprises of profit. And this could, at the end of the year, add up to your net profit for the company, and thereby exposing yourself, Thaiko exposing itself to corporate income tax, and thereby you would not, for the purposes of international tax planning, you would not want to have this transaction taking place. You don't want to have the sale contract taking place here. You don't want a sale contract to take place here. Okay? And also, of course, you would not want to have, the income coming here. Because this 20 baht here has profit in it that could affect the net profit of the company, Taiko, and maybe expose itself to Taiko's CIT. So what you would do to try and reduce your corporate income tax, Taiko's corporate income tax exposure, at the end of the year or the accounting period, is for Taiko to set up a company. Alright, we call it box company. Alright, in a tax haven country. And as your notes has already explained to you, what is a tax haven country? A tax haven country is a country that has jurisdiction or its laws providing no corporate income tax or very little corporate income tax. So the aim of transfer pricing now is to try and somehow move the profit in this 20 baht across into this box company, not have the profit of 20 baht come here. So the way you would do it is Taiko, that's you, alright? You would inform your customer, Kenko, to pay I use a thinner line, sorry. You would tell your customer Kenko to pay box company the 20 baht here. 20 baht per piece. Garment. Box company would of course invoice Kenko for the payment of garment, right, at 20 baht per piece. Of course, in reality, it will be like, a ton of garment or a lot of garment. But for our simple explanation and understanding, I put it as just garment per piece of 20 baht. Alright. Now, the 20 baht will come to this box company here. Taiko would invoice or send an invoice to Boxco for Boxco to pay, let's say, for example, 13 baht purchase price for garment per piece. Okay. So invoice here, 20 baht per piece for the garment. Taiko invoiced the box company for garment at 13 baht per piece. Now, as you can see, the 20 baht is here, right? Boxco would pay Taiko 13 baht and thereby realizing a 7 baht profit. Right here. The 7 baht profit would be in the bank account of the Boxco in the tax haven jurisdiction. the 7 baht profit would be subjected, depending on the laws of that particular tax haven country, the 7 baht profit will be subjected to no income tax or very little income tax. The 13 baht coming here to the Taiko, there's a certain profit to it, but not a lot. Okay? In other words, when you talk about transfer pricing, the word pricing in transfer pricing really means transferring the profit that is in the price, the 7 baht, into a low tax or no income tax having country. Alright, there is a certain profit here realized by Taiko from the 13 baht. It's a baht, it's a very low profit. Now, because this method of transfer pricing is used so commonly, as I said earlier, alright, the Revenue Department of Thailand and in many countries of the world has methods, even formulas, to make sure that this particular amount, the 13 baht per piece here, is the real purchase price, not something made up to just transfer profit to a low tax jurisdiction or no income tax jurisdiction. How would they check if this 13 baht is real? Well, one of the most common rules they apply is a principle they call arm's length principle. I just write it here. Arm's length principle. Or should, actually, is to say the full name is at arm's length principle. At arm's length principle. In other words, the question to be asked by the Revenue Department is Taiko and Boxco at arm's length? Is Taiko and Boxco at arm's length? Meaning that Taiko and Boxco are not related. If they are not related, these two companies, Taiko and Boxco, are at arm's length. Okay? If they are related, then they are not at arm's length. Which also means that this 13 baht is not the real purchase price. And therefore, if the Revenue Department decides that this 13 baht is not the real purchase price, these two companies, Taiko and Boxco, are not at arm's length, the Revenue Department would investigate further to try and realize the real price here, and thereby subjecting Taiko to corporate income tax at the end of the year. So, perhaps the key to this method at the end of the day is to try and be careful with this amount to ensure that this amount is realistic. Alright, for students, the way to test your understanding, if you think you understand transfer pricing methods here, alright, the way to test your understanding is perhaps to reverse this transaction the other way around, alright, and think in terms of Tyco as the purchaser and Kenko as the seller. Alright, and see how would the transaction work then if the selling starts from here rather than from here. Alright, then test your understanding in that way to see how the transaction will work. It's basically the reverse, but it will be a good way to test your understanding if you think that you understand. Alright, Kenko will be the seller. Kenko would have to now be the one that set up this box code in the tax haven country, and then the situation will be reversed. That's all on our lecture here on transfer pricing technique.